Hi, folks. I think we're going to get started. If we're ready. We'll give it another minute. Yeah, there's no difference. All right. Well, thanks for joining us at this workshop focused on climate tech. So my name is Dorothy or Drew, and I'm actually a first-year student lead at the Yale SOM Energy Club. And I'm just going to set the stage briefly and hand it over to our wonderful speaker. And so we're really lucky to have Pete here with us. He's a venture investor and advisor in the energy, mobility, and industrial sectors, focused on using the power of networks to scale climate innovation. And so he's actually a principal at Broadscale, which is an energy and mobility-focused investment firm that also advises Fortune 500 companies on venturing and innovation. So Broadscale operates the Broadscale Network, which is a consortium of some of the world's most leading energy and industrial firms investing in venture-backed companies to scale climate change and mobility solutions. So pretty exciting stuff. And so Pete started at Broadscale in 2014, and since then has played kind of a huge role in building the venture investment platform there, and has invested from seed to growth stage companies. And he's also an active B2B investor with a portfolio that spans climate, mobility, software, fintech, a lot of things.
A lot of things.
Yes. And so more personally, Pete is a very proud Duke grad in public policy. So please welcome.
Against me, please. Thank you very much.
Please join me in welcoming Pete.
Thank you, Drew. Greatly appreciated. It's great to be here today. As I was just telling Drew on the way in, my career has taken a bit of a circuitous path to Broadscale, at least at the start, and then I kind of planted seeds and have been at the firm for over 10 years. So kind of an anachronism in this day and age. I found that I really love scaling climate solutions, as do I think many of the people in this room, and I'm pleased to share a bit more on my experience bringing that actually into practice in a real setting. Because if I reflect on climate solutions, it is such a catch-all. This is such a broad category of solutions that we're trying to bring to scale. And if you talk about overlaying that with climate VC writ large, VC is everything from pre-revenue, pre-seed, all the way to growth stage pre-IPO. So when you matrix those two things on top of each other, there's a lot of work to do, and I'm grateful that all of you are joining me in doing that work. So Drew shared a bit on my background. I've been privileged to partner with companies from the pre-seed all the way to the growth stage. So again, a very wide aperture. And I've been investing in hard tech solutions, so solutions like Proterra, which has been building until recently, a leading battery electric bus platform, manufacturing platform in South Carolina here in the United States, all the way to financing solutions like Generate, which are across the cap stack and help scale solutions writ large. As mentioned, I've been doing it from the earliest stages all the way up to the growth stages, and a lot of interesting insights. I think one of the things that I would share off the bat is that it's been incredible to have such an influx of new types of investors into the space over the last, say, 3-4 years, right before the passage of the IRA, but especially post. And one of the interesting things that's occurred is there's been an influx of many SaaS investors. So Broadscale, we've been investing in solutions that are more data-oriented and SaaS-oriented, like you'll see firms Via here, firms like Measurable, firms like Arcadia, for some time. But I continue to learn a lot from new VCs entering the space and new forms of capital entering the space, the likes of Union Square Ventures and others who are really focused on that kind of discipline. So it's a broad space, there's a lot going on, and it's been a pleasure to be at Broadscale in particular because we take a pretty unique approach to scaling climate solutions. And you know, a lot of firms like to talk about what is your kind of unique edge, how do you scale firms as a matter of platform, and really the way that we do that at Broadscale is through corporate partnerships. So corporate partnerships are critical in our space. We like to joke that there's no such thing as, you know, two guys in a garage scaling climate tech, right? And a dog, or two gals and a dog, right? Climate solutions are capital intensive. The markets move slowly. And so understanding on the front end what the corporate buyer universe wants to accomplish, wants to achieve, what their priorities are, what their capital deployment timelines are, whether they're willing to allocate CapEx, whether they're willing to allocate OpEx, is really critical. And so it's smart investing sense to get to know this community and kind of what their purchasing cycles are. It's also just good platform since, in terms of we really love to take these companies in our portfolio and cross-fertilize and grow them through partnerships with the corporate partners that we work with. So it's a really unique model. We don't have a fund. We're probably the largest fundless sponsor you've never heard of. We deployed about $150 million across 15 deals without a fund. And for me, as someone, you know, and I love to always drop some personal anecdotes, I joined the firm in 2014. I've helped us build this out. As someone who is more entrepreneurially minded, this has been the right path for me. I think some people would maybe hit their head against the wall sometimes trying to do deal by deal deals 15 times over. I happen to be a glutton for punishment, maybe. So it's been an incredible journey, and we've had the flexibility through this model to bring in many different types of capital into the deals that we do. So we bring in corporate capital, this corporate network that we work with. They have the optionality to join deals that we do, but they don't have the requirement. And then we also have about 150 high net worth individuals, family offices, different LPs that join us in our deals. And one interesting insight from that is that community, since we started our deal by deal investment platform in 2015, that community really does want access to climate deals. They want access to decarbonization. They want access to impact. And so one takeaway I'd leave with you is that, you know, there is definitely latent interest among the high net worth individual community, family office community, et cetera, in participating in these deals. And there's been much more structured ways. I wouldn't, you know, say that we are a structural solution for that community, but likes of Creo, you know, very focused on aggregating capital from that community. And there's definitely others that I won't mention. So it has been a pleasure helping to build this platform out. And you know, I think just to kind of recap our theory of change and how we think about things, you know, it's essential to know the corporate community and the buyer universe because, again, as I shared, ClimateTech is so incredibly broad, right? So if we're going to decarbonize the global economy, we need to understand what's happening in all of these spaces, and we ultimately need to sell solutions into these firms that are represented here, right? And we need to understand technology readiness. We need to understand capital allocation timelines. We need to understand unique financing mechanisms. Like if you look at the ag bucket and you think about nature-based solutions or, you know, NBS and things that are selling into that bucket, financing that with carbon credits looks tremendously different from energy as a service solutions being sold into the built environment. Looks incredibly different, right, from, I don't know, scope 2 accounting, like the likes of Arcadia and Measurable are two portfolio companies in that space are doing, right? So there's a lot of embedded and complex B2B sales cycles, go-to-market strategy, and kind of venture tactics that are required to accomplishing the decarbonization puzzle. So that's a huge part of our theory of change. And to kind of burrow maybe a level deeper, it really comes down to, in many cases, trade-off decisions around very specific technologies that a very specific buyer is making, right? And so I like to highlight this one because we're going to talk about it a little bit later when we jump into a case study that I'd like to share with you all. But just look at the transition from diesel fleets in the medium and heavy duty market to EV fleets. The actual trade-off calculation for that is very much market by market, state by state, right? So this illustrates PG&E California specific trade-off, which encompasses local incentives, LCFS credits. And now it's pretty clear that you don't even need to be a green thumb or someone who cares about decarbonization. You're going to make a very rational economic decision to buy an electric vehicle to benefit from the total cost of ownership savings net of incentives over the next 10 years. Now, if you did the same analysis here in New Haven, I don't know, right? So it really depends very much on these kind of micro decisions. And when we're scaling ClimateTech solutions, we need to be cognizant of those. Need to be cognizant of, you know, okay, there's a theoretical TAM, but what's the SOM, right? And the SOM looks a lot like this, and then it grows over time. I want to add a couple more thoughts very quickly about ways that business model innovation are helping to scale these solutions. So this is something we've been hung up on at Broadscale, and actually, I would say it kind of informed the start of my career. So I started my career at UBS in the investment bank in 2012, 2013. And I spent kind of my nights and weekends and evenings reading green tech media. Any green tech media recovering fans in the audience? Yeah, right. And Julian Spector, editor there, happens to be a good friend. And so I was getting very excited at the time by the next wave of innovation. That's actually why I joined Broadscale in 2014. But at the time, it was all a conversation around no money down leases. No money down solar, being pioneered by the likes of Sun Edison, eventually then Solar City, eventually then Sunrun, and then eventually similar types of offerings for behind the meter storage as pioneered by STEM, right? So these types of business model and financing innovations, we've loved as Broadscale, and we've sought them out for a long time because they really do help catalyze customer action. And so it gets back to, again, these types of decisions, right? If you can actually benefit and realize as a customer in more of an OpEx way, TCO type savings, you're going to make that decision on a lower cost basis every single day of the week. And so I'll highlight another example from our portfolio, Proterra, where they partnered with Mitsui and effectively put the battery system of that bus into OpEx out of CapEx. And the net impact of that was to have the total cost of ownership of the vehicle be less than the total cost of ownership for diesel, CNG, diesel hybrid, right? So it's these types of innovations that are being ultimately driven by entrepreneurs through entrepreneurial, kind of zeal and experimentation, right? Experimentation that are driving adoption of clean solutions. I'll highlight one more, and I couldn't not have an Obama photo because it just felt like an incredible opportunity, an incredible moment. Another portfolio company of ours, Incopa. Anyone familiar with Incopa in the room? Okay, see a few hands. They were one of the early pioneers in kind of pay-as-you-go solar in Africa, and have now expanded into smartphones and expanded into other product categories, micro loans. And their real innovation was a simple one, pairing microfinance and distributed hardware, right? And so a similar kind of thing where there was a latent opportunity to commercialize a solution that was net great for the planet, effectively replacing kerosene style lighting, heating lamps, lighting lamps with solar plus battery powered solar, and doing so in a way that was affordable through a micropayment type methodology and business model innovation, right? So if you can't tell, we're kind of zealots for this type of innovation, but it actually, again, is a way to bridge from these very complex trade-off analyses that folks have to make, and to make them quite palatable and accessible to customers. And once they're accessible to customers, ultimately you can scale just about anything, which is incredible. Okay, so a little more foundation, and I'm sure many of you are avid readers of CTVC, as I am. Sophie Purdom is a great force to be reckoned with. Kinzu, Zhao are incredible. And so they do a lot of research on the capital that's coming into the space, right? And I think the big takeaway is that the amount of equity dollars available is robust. There's certain parts of the capital stack right now that might be a little bit less robust. I think in the growth stage, there's still a bit of a missing opportunity. There's a huge opportunity in first of its kind financing that I'm sure many of you are thinking about as affecting your work and commercializing new technologies. But overall, the equity picture for the types of experimentation I was just talking about and the type of business model innovation is quite robust. So we're in a good spot. There's a lot to feel good about. But I think in order to not have the kind of ClimateTech 1.0 experiences that we had, this capital needs to be used judiciously, right? It needs to be put behind solutions that are able to achieve kind of market readiness, right? And I think for the most part, it is. And also, certainly a lot of it has to be put behind moonshots if we want to achieve our decarbonization goals. So there's no kind of broad strokes takeaway about this particular picture, except I would say that obviously our goal is not to fund saving the planet just with equity, right? It's to fund it with debt and other kind of more cost competitive sources of capital, right? And so the goal is to move, as we move through the technology maturity life cycle, it is to move down the capital cost curve and have things be bankable, ultimately with debt. And I think this is a little bit optimistic of a chart because it says we're going to be debt financing our projects at TRL 9 with 80% debt and only at Series B. I know companies that don't even have a first project yet and they're at Series E or whatever. So I don't know about this, but I think this is really the end state that we're all trying to strive for, right? So that sets up a really nice case study from our work at Broadscale and an investment that we made last year that I'd love to kind of bring the room into and ultimately get your thoughts around it. And that is with a firm called EV Realty. So if we talk about kind of business model innovation, financing innovation, EV Realty is just that. This is the application of a great entrepreneurial team behind a kind of intractable problem, which is we have, again, as highlighted earlier, this real interest in decarbonizing medium, heavy-duty vehicles. We simply don't have enough charging to support it. We don't have enough grid power to support it. So we got to know this great entrepreneurial team, very strong development background across Patrick, Wyatt, and Sean. They've since hired 11 other FTEs. And I'm going to dive in a little bit to just kind of the opportunity that we saw, and then some challenges and different things that they wanted to think through, when scaling the business. And then we're going to ask you all how they should have decided to scale the business. And we'll see if you're right, we'll see if you're wrong. All right? The first thought is just on getting to know this team, it does pay to be friendly. So this is a ClimateTech talk, maybe not so much a venture talk, but the way that I sourced this deal was through talking to a smart friend of mine and hanging around the hoop, so to speak. So, for all of the kind of things that we need to accomplish in the climate land, it's important to remember if you're in the venture game, you got to be out there doing business development. So just a kind of funny aside. But we already had an existing thesis as Broadscale around fleet electrification. Right? As I said, we were investors in Proterra. I didn't mention we were actually investors as well in Revel, another company scaling last mile fleets, more on the customer side. And so it was abundantly clear to us that for total cost of ownership reasons, and also because of simple kind of GHG reduction goals and targets reasons, this customer base is going to procure electric vehicles. And we already talked about this. The economics are there. The problem was, and I'll just say, sometimes in venture, you kind of know there's a problem, but you meet an operator team that's so active in that problem universe, they educate you on it, and they bring you to full conviction. So maybe you're at 60 to 70% conviction, and you talk to a team that's really done their work, and you're like, wow, like this is an in-the-money opportunity. Well, that's what happened with EV Realty. So they had done some very impressive work in and around the LA basin, effectively determining that less than 2% of viable circuit segments in Southern California Edison's territory could support 5 megawatts of charging or more. And you'll see in a minute, a lot of charging needs in a fleet context are not 5 megawatts, they're actually more than 10 megawatts. So it's a huge problem if we're going to be decarbonizing the last mile, which I think a lot of us would like to do. And if you drill even further in, the amount of capacity that is available where distribution centers already exist is even worse, right? And so if you're a Prologis or if you're another kind of major player in the last mile space, maybe a Lineage, this is a massive problem. You need to decarbonize your transportation solutions. You don't have the real estate, and you don't have the power. And actually, the power is harder to solve than the real estate, right? So we were getting more educated on this opportunity and becoming more bullish as investors. And another component of it is we certainly need many more fast chargers. We did a lot of research on the actual need on the capital side, projected build out of all these vehicles. But the thing is, it's a little bit chicken and egg. If you don't have infrastructure, the vehicles themselves aren't going to come, and the capital is not going to come. So we saw charging really as the key choke point. Okay, what is EV Realty doing? So EV Realty decided to put together an end-to-end solution to structurally solve for this problem. Pretty interesting. And they decided to start initially through leasing and not through acquiring to be more capital efficient. Okay. There's a lot of business model innovation and kind of broad scale, magic in what they're trying to do here, right? And so the model fundamentally is, as I said, they're starting with leases. They're going to lease property. They're going to improve and develop the property with EV charging and put in that CapEx. And then they need to solve the contracting layer to make this something that's not just an equity project, but ultimately a debt project, right? And that is, that kind of third chevron space, that is like where the real magic happens. is the contracting side. Because once the debt universe gains confidence, as we said before, in mortgage building, and you can bridge from equity to debt, you've achieved sort of the equivalent of product market fit in SaaS land, here in climate land. So that's what the company has really endeavored to do. And so from our perspective, we had a lot of confidence in the ability for the company to figure this out, given how strong the management team is. I didn't go into all their bios, but great background from Clearway, great background from 8 Minute Solar. And so this was, as you can kind of tell, this was a bet on their ability to figure this out. There is a lot of precedent in companies of this type creating incredible market value, just not in the climate space, right? So I mentioned earlier, applying SaaS analogs to climate can be fruitful. We can apply real estate analogs, other forms of financing analogs to climate, and it can be quite fruitful. And that really comes down to that maxim that I shared at the outset, which is that climate is a bit of a catch-all. This EV Realty ultimately is a real estate company with a climate focus. So Digital Realty Trust is an incredible comp for this business. Effectively leases data centers to tenants, trades on cash yield. This is what EV Realty is trying to build ultimately in the charges. Okay, so I'm going to throw a lot of specifics at you guys, and then we're going to do a case study. The specifics are not, don't worry, you don't need to capture all of this information, but by way of background. So as Broadscale, we needed to then figure out how we could underwrite a company that doesn't have a single project yet, but is a project development business, right? So a little bit challenging. And the way that we did that was we decided to standardize around kind of what you might call a base project. So there was an iterative back and forth with the management team to figure out, okay, what's a base project? Obviously projects in this space are going to be pretty anomalous, but how do we align around something that is more or less standardized? And so that was an intensive period of, March 22 through July, of last year, call it, however many months, call it 4 to 5 months of really leaning in with them on contract potential, structure, and also stats like this on how much CapEx is required, how much power is required, what does that mean in terms of actual site availability, what's the scarcity value thesis. All right, as mentioned, contract structuring is actually like the key value driver. And, these are hypotheses that the company had coming into building this business. Ultimately, as with any good venture-backed business, you have hypotheses, but the rubber meets the road where the customer is actually willing to transact, right? So ultimately, the company came in with a lot of thoughts as to what that logo universe, last mile fleets, okay, the FedExes of the world, the Pepsi, Prologis, what they would be willing to pay for. And it ranges everything from, I would say, the full Monty of a lease for a full site that EBR developed. That's incredible, right? You can take that to the bank any day, to something that looks a little bit more like, Airbnb, right? Which, people tell me they're financing that these days, but that's going to be harder to do and to stack in a beneficial way. So these were the hypotheses that management had as to how to ultimately structure these contracts. But it was always going to be proof is in the pudding, rubber meets the road when you actually start talking to enterprise fleets about that. But we'll come back to that. We did a fair bit of underwriting on projects themselves in terms of sizing and offtake and just kind of their profitability profile. So again, I've just brought back the typical characteristics. And in California, it was clear, and I'm not going to share all the details, but it was clear that these projects penciled, right? And it was clear that even with assumptions around LCFS pricing, and LCF pricing has gone down, that the projects would pencil. And so you got to always do your due diligence, especially as anyone wading into project land and venture capital, and we did that. All right, so this is where I would like to shift a little bit to a case study exercise, if my handy helpers can help. So a really interesting kind of catalytic event in the business happened in June, potentially catalytic, in June 2022 of last year. So the company received a term sheet for guaranteed asset purchases. And this was not out of the blue. They had been talking to the financial counterparty, who I won't name, for some time about a potential offtake of the projects and of the assets that they would be developing. It's important to note that as of June 2022, they hadn't raised any outside equity. They have pipeline on a piece of paper in terms of projects that they're interested in. They have pipeline on a piece of paper in terms of off-takers for that. So pretty early, days for the company in terms of maturity. And maybe I'll just share one other thing about this management team, which is that they decided to build this business after careers, the likes of Clearway, as I said, 8 Minute Solar. Maybe they don't like the idea of capped upside. Okay. Because this was their big entrepreneurial venture, right? So it's kind of worth keeping in mind. These discount rates now I think look a bit favorable. Keep in mind, LIBOR was 1% at the time. But look, this was a real interesting moment for this business insofar as they had, what some entrepreneurs might view as a golden ticket of sorts, where they had the ability. Now, it would be an iterative process at a governed IC, but they had the ability to effectively sell projects they develop at very pre-wired terms and get this thing off the ground. So, what I would like to maybe do, because I was given free license to put you guys to work a little bit, okay, is divide up the room and conclude collectively, is this an offer, if we were the entrepreneur or the operator, is this something that we would take? Is this something that we would want to proceed with? And the question is, why? Why or why not? How much debt do you think the business needs? How much equity do you think the business needs if it doesn't go that way? Might not even need debt, okay? And what other kind of use of proceeds considerations might you keep in mind? How much working capital? Let's assume you want to have, the company has 14 FTEs now. Let's assume you want to have 14 FTEs in the company. And let's make some other assumptions. We want to have 8 projects started within 2 years. That's the company's goal. And projects take about 2 years to develop the COD. And the dev cost of each site is $9.3 million, assuming that they lease and don't acquire, which is the initial assumption. So I've been told I can break up the room. Do you want to do that? Yeah. Okay.
Okay, so we'll just work with people near you. So these first 2 rows, and then the back 2 rows over there, these front 2 rows, and then we'll split back 2 rows there, maybe parry over, and then front 2, back 2. Just turn around and work with your groups.
So talk amongst yourselves, decide, and you can have a response that answers most of these questions, all these questions, but would love your thoughts on what you would do if you were in their position.
I was even dozing off because I was I'm not sitting there and I see your
It's also interesting to hear.
What do they know that
Lifetime value. Where do you see it? Something about like
They really don't have any compliance.
I don't like the fact as an investor when we have money, like we would make sure at the end that he would have to go on now, and so
What's the deal with you?
but they still have.
All right, let's give it maybe 60 more seconds. Pick a representative who's going to speak on behalf of your group, and then we'll reconvene. All right, we're going to reconvene. This was a thought exercise. There's no wrong answers. In fact, there might even be some kind of confusing information up here. I promise it'll all make sense in about 2 seconds. But so if we could pick maybe one representative from each group to just kind of summarize your answers to the questions. All right, who wants to go first? All right, we got him. We got her.
We wouldn't accept their role for.
Okay.
No deal.
Like, we want to have enough capital to both develop and fund our operations, so it has to be a joint deal for us in order to proceed. It's how we need to develop and work, and
You need working capital.
need working capital primarily.
Okay. Yep.
So we don't accept it. Well, the question is, how much do we currently have? Maybe we missed the slide, but how are you capitalizing the business? Obviously, we started with our family funds, and we're
Friends and family. Yeah.
So we don't have anything
And
beyond that?
associates. No.
So
There
how
would
do we get
presumably-
someone that big?
There would be an equity plug of some kind from somebody. Right. Does that change your answer?
I guess. Well, because that's a big offer, right? Like, there needs to be a seed, pre-seed, like someone smaller giving us like $5 million to just get through the next 2 years.
Well, I think the point is it's an insufficient offer. It's a big offer, but it maybe checks some boxes, leaves others. No, but great critique. Okay, how about this group?
So our reasoning was not as detailed, but basically our thought was we would not take the deal because it removes any opportunity for experimentation in terms of like different contracting types. I think someone mentioned that if this is a relatively new type of way of doing business, that there's a definite benefit to maximizing the cash flows you can get by like doing the subcontracting, doing the Airbnb style rent to spot type thing. So, yeah.
Absolutely. Yeah. We'll get to that in a
We
minute.
felt that this just put a limit on what we could ultimately earn, and that because we're early in the market, we probably could have higher potential.
Yep. Love that answer. All right, we'll circle back to that.
Yeah, we were leaning towards passing. We didn't really come to a clear decision. But I think another concern on top of what's been said is if we're just like building up a competitor, if like depending on whoever the investor, they're like looking to grow in this space past the initial purchases.
That was actually an objection that I forgot about. So great job. All right, how about this corner of the room?
They want me to speak, but I feel like I shouldn't.
Perry's a biased interlocutor, whatever the word is. Go ahead.
I say take it. There's a lot of upside you're leaving on the table, obviously. But I think my concern is like they haven't done anything yet, right? So this is like a new company, very risky, and they need a lot of capital to build the projects. If we're talking about like getting debt financing, like some kind of contracted revenue would help. I mean, they're still taking the risk on either way, because the only way these people take their projects off their hands is if they're successful. But it might help you get to debt financing faster, which means you're not investing off balance sheet, which means you have to raise a lot less money. You're still making a good deal of cash.
Going back to the axiom, maybe it accelerates the path to debt.
Yeah. Plus, it's a super risky play either way if it's like really the first of its kind. But at least this way you get like a proof of concept and revenue.
Okay, love the contrarian take relative to the room. How about back right there, back left?
Nothing, fabulously new based on what's been shared, but everything that what you said about the founders having this entrepreneurial spirit, and it seems like it has a capped upside, which wouldn't be attractive.
Great take. Okay.
Can you explain why on these words it means they have a capped upside?
Yes. So with a pre-wired discount rate, and I should have spelled that out perhaps, the only point of negotiate pre-wired discount rate valuation methodology for calculating the NPV and project value. Basically, their sale price is capped, right? So there's not performance beyond that unless they could effectively iterate on the business model, further beyond that. Yeah, so there's a bit of a cap there. All right. Okay, others, this side of the room.
So I'm going to concur with the fact that we still need funding for the work capital. But the part that was kind of decisive for me is the fact that the whole process is out of our control, which would limit further down the road the contracts that we would be able to take on. So I would say no.
Yeah. Great. Okay. Anyone else from
I think most of our concerns
side?
are already been mentioned.
Okay. Sorry for the extended cliffhanger. Thank you. That was very thoughtful. I think you guys touched on most of the points that led the company to pass. So ultimately, the company decided not to take this term sheet, and the real motivation was not only did they want to have control and not be privy to a third-party investment committee process, they also ultimately don't want to sell projects in this business model. As you'll recall, the goal here is to create sort of the digital realty trust of EV charging, and that means having retained lease cash flows and ultimately trading on the public markets, presumably based on a business model that is, based on having a cash flow-based business model. So, Perry, you're right. You could bootstrap things more quickly by selling projects, reinvesting the proceeds, iterating, and all that good stuff. This team wanted to bet on itself and say, let's just skip a step and let's go straight to it. So what did they do instead? This is going to be interesting. They decided to raise a unified, all on balance sheet mega seed round, and so maybe the largest seed round that you've ever heard. But actually, it's not really a seed round. It's a bit of a misnomer. Okay, it's seed development round. And the idea is that they would have ultimate flexibility in working with a really incredible tier one VC, private equity firm, and GP, in determining how they allocate capital to working capital, development capital. You can iterate on structures. We don't have to worry about the structures not flying with the investment committee, right? We can be real entrepreneurs, risk takers here, in iterating on the next generation of business models around EV fleet charging. And so it also has a lot of ancillary benefits. They can mature the pipeline more, right? Gives them more leverage in future debt capital negotiations. Talked about contracting. They can mature the supply chain. I think one of the interesting things that was challenging about this business, if I can just reflect on since this deal closed in October, the supply chain for things like switchboards, chargers, it's been really challenging. So it's been great to get that flywheel going. And then they can hire the right team. So all of this gives them more leverage the next time they have to go to market from a debt perspective. And so that was really interesting. And just for as a kicker, they've also raised debt around the projects And so that was just one of the things that no one really took the bait on. But they believe they could get effectively, 70% LTV on these projects. Now, it hasn't cleared at that. I won't tell you exactly where it's cleared, but obviously debt markets have gotten a little bit stickier. But net, if you plug in $5 million for working cap, plug in some debt, this $28 million lets them accomplish, 8 projects at this kind of base project sizing. So not a bad initial portfolio of projects for a seed development capital portfolio. Okay, I'm going to do a slight time check. Let's see. I think we have time to keep going for one more round of audience participation. What do my helpers think?
Yeah, I think you've got time.
Okay, let's do it. Now, this is really more of a teaser because if you didn't come into this room with this idea already in your mind, you're probably not going to think of it because it's esoteric. But now that we know that they did go this path, and if you were management today and you have a robust set of 8 projects that you're developing, maybe there's a solution kind of lurking in the markets, maybe the property markets, maybe the PropTech markets, that would unlock a lot of capital for your business. I'm actually not going to do a group breakout for this one because it's just too much of a esoteric thing. But does anyone want to offer a creative capital solution that this team might want to go out and explore now?
Electric vehicles as a service. You just go take the vehicle, drop it.
That's definitely a contracting model they're iterating on. But I'm talking more about a capital solution for the whole business in line with the term sheet they turned down.
They could look into venture debt.
Yes, they definitely could do that. Not, again, I'm looking for some really specifics, so sorry. That's not a bad idea. And in fact, they're doing more kind of asset level debt, but I think they'll put debt on the whole platform as well.
PACE financing?
Good idea, and I'm not going to have us keep stabbing in the dark, but not it, yeah.
Do they just work with an investment group to purchase the properties and then develop them through some sort of financial vehicle?
Yes, that's effectively what I'm getting after. And so I'll stop the pain because it's very specific, and if you're not in real estate land, you probably wouldn't have thought of it. There is a thing lurking in PropTech land called a PropCo-OpCo structure, right? So if any of you just spat out this full thing in its entirety, I don't have any $100 bills on me, but I would have to reward you somehow. But there are many different ways to accomplish what this accomplishes. But the idea here is that there are somewhat structured ways to leverage real estate capital markets to achieve very low cost of capital for a real estate product that has fundamental and inherent value. And, I didn't kind of give you guys enough seed thoughts to come up with this on the spot, so apologies. But this is a really interesting structure that has been traditionally used more in PropTech markets, where, in PropTech, again, being VC as applied to real estate, technology applied to real estate, where the OpCo has a fundamental technology intervention that is increasing the NOI or the yield on the asset, and they are allowed to effectively get above kind of market returns utilizing that, and there's an arbitrage using the fundamental property value. Okay, so this is just something we can all read more about after this discussion because it's quite esoteric. But what it means is effectively, and I'll just add one other thing, Alpaca, one of the investors that joined us in a round, actually has a whole fund around this, so you could read about that. They've done a lot of great public work about it. But effectively what this means is that at some point, if EVR were to pursue this, they could pay a pretty base lease, call it a 10-year lease to the PropCo, and then they could go do whatever they want to monetize that property asset above and beyond that lease. So it's effectively an arbitrage on their own ability to go out and monetize this parcel of land way above and beyond. So this might be like industrial outdoor storage, or some parcel of land that has fundamental value, just doesn't have as much value as what EVR is going to go to in their contracting structures. So really fascinating concept. I can neither confirm nor deny if this is in play for the company, but I will say this is kind of a way to get even sub 10% cost of capital on land, call it, quite competitive, and then go do the types of contracting things that we were talking about to achieve some really attractive returns. So there's the era of financial engineering is not dead. That's basically what I would say. Let's see, we've got 5 minutes. There's one more challenge this company has to solve, though. So I'd love your thoughts in trying to solve it. We talked about all these creative contracting structures, but we haven't really settled on which would be the best. It might be somewhat obvious, but also there's the question of what will the market bear? If you're a customer, if you're a fleet that's electrifying, are you going to be willing to effectively lease a site for 15 years to solve your electrification needs when you don't know exactly what your procurement timelines are for electric vehicles? I don't know. So I would love to maybe bring our groups back together one last time and let's answer some of these questions. If you're the management team at EV Realty, what contracting structures are you pursuing? How does odds of success inform that? What kind of customer types among the left might you want to go after and why? Or the focus on the team, keeping in mind that this team started as a development team, effectively 3 development professionals, or focus on the team that you need to add from just a hiring perspective. And I think we actually sort of already answered the last question, so we'll spare ourselves that. But let's break up for maybe 5 minutes, talk about this, and then let's bring it all back together to close.
This part I can relate to a little bit more than the like financing part of it. But so I guess it's just like one of the first I mean, there's definitely like all of these different any one of them is I think like so much of it is in the execution of
Why do you have to choose? Can you offer a menu?
Well, some of them kind of have to choose, like, if you're going to do a full site lease, then you can also do, like, the subscription and the EDF service. Like, you could probably combine some of them also like today right now like fleets are experimenting with it, so they're like 5 kind of to get maximum utilization. I think have a model that's gonna be able to serve like multiple versus just like one fleet. That's what I would because you were dying on it. Like maybe there are a couple I think you would want to mix and match to maximize yeah, so you
At some point, I like hardware cars more places secure straight.
So that first one, I think represents for like if you're doing so then you're gonna match like a couple of different fleets that have kind of complementary needs, like school buses that need it during the night, garbage trucks that need it during the whatever, different times of day.
No, I think you're right.
That did lose the first.
Leasing overhead space to someone else. So you can charge underneath. There's maybe even building yourself.
All right. There is this is startup land. There's no definitive answers. All right, so but there are good answers. So why don't we start with the back left? You guys seem primed and ready to go. Would love to hear your thoughts.
Customers to just one.
I think we wanted to like the first option.
Yeah.
One of the things we've talked about most is the utilization risk, and it seems likely, or certainly very possible, that within 10 to 15 years, the market will completely change, and that's a pretty significant risk to take on here.
In terms of doing anything long tenured.
Yeah.
Yeah. Like that answer. Front.
Yeah, I mean, I can say, I think we also like the first one. We wanted to kind of secure some revenue stream, right?
Yeah.
Pay as you go would probably, then you would open up to competition eventually, right? So you might not secure, you don't have the visibility that you need at the beginning to generate the cash flow that you need to keep growing, right?
Yeah.
So that was the, and same 5 years seemed, a good way to experiment, 10 to 15. Who knows, right?
I'm not taking that long duration risk.
Yes.
Yep. Okay. Some consensus over here. Further consensus?
We like the first option in part because we'd be utilizing different customers and expanding our base and having opportunities to explore different models. We looked at number 4 as well, but we think there's a business opportunity there, but not necessarily for this team trying to add that as a second business where they don't have any real experience there.
Great points. Great points. Okay. How about the back?
We chose probably a combination between 1 and 3 because you can have more utilization from one parking spot. You target logistic companies and corporate fleets because you know that corporate fleets might use the parking spot at night. And if you use logistic companies, you might gonna have a more utilization rate of the same parking spot. So probably a combination between 1 and 3.
Great. Creative. I like it. Okay. How about over here?
I like the combination between the first and the last. One of my colleagues brought up that, based on what happens in that region of California over the next 5 to 10 years, if they bring in a lot of new infrastructure, this company loses a substantial portion of its competitive edge that it has right now. So I think going with the first option for the majority of the time, but hedging some risk where if they start to see the market go, they can then directly market those properties to these companies and just sell them.
Bit of an escape valve monetization.
Yeah, and then go to develop somewhere else in the country that has similar.
Yeah. Kind of funny enough, bringing in some of the benefits of that initial asset purchase term sheet, but just doing it not inside of a kind of equity capital purchase structure, just selling it to a customer, getting monetization. Interesting. Okay. Did you all have anything burning front? No? Okay. Let's go over here.
So, we were thinking also the first one, because of the moderate tenure, because it's more safe to start. And for the customer profiles, we're thinking about heavy-duty fleets and logistic companies, because that more fits into the first model. Because usually for heavy-duty fleets, they need to stop at some certain points in the highway, so that's very kind of certain that they can capture the market.
Like that a lot. Yeah, didn't press everybody on answering the bottom left, but that's actually a great answer. And another thing, heavy duty fleets is their kind of dwell charging load is 2x that of median. So when you think about the actual utilization benefit, it can be up to 2 times as much. So, great answer.
We went with the more risk-averse approach, maybe thinking about EV as a service, so longer-term agreement. If you could figure out financing on the front end, so because you're putting up all the capital there, then also you have a guaranteed cash flow stream if you ever did need to get trouble and need to borrow against it or something like that.
Yeah. A bit more entrepreneurial, but I like your faith in the team. You haven't met him yet, but we'll have to make that happen.
Well, it is also that there are so many people who would like to invest in green technologies,
Yes.
but maybe they do not have the capital. So we would offer you a way to become more green by proxy.
Yeah. And actually, to your points, the customer lift for that one is incredibly low. It's I'm buying the product. And so there's a company doing that today, actually, in Port of LA called Watt EV. And they're effectively doing that. It's vehicles by the hour, trucks by the hour, electric vehicles. So, spot on. Okay, and did we get everybody?
We should probably wrap up.
We should wrap.
Yeah.
Okay. Takeaway is there is no correct answer in startup land. But this type of iteration is where the rubber meets the road in bringing new businesses to Broadscale. So thank you for your time today.